All right, we are live. Good morning,
Good morning.
everyone. Welcome back to Stock Talk on the Stock Unlock YouTube channel. In this in this live stream of Stock Talk this week, we're going to really be diving into Robinhood's earnings to start us off because it's just a really interesting company to watch and pay attention to. Full disclosure, Jake and I are not invested in Robinhood. Don't think we ever will be. And maybe we'll explain why in this live stream. So yeah, just good morning, everyone. Thank you all for tuning in. And how you doing, Jake?
I'm doing great. It's a gorgeous day here in New York City. I usually wake up at around 9:30 or 10, but today my body said, you're waking up at 6. So I've actually been awake for a while, got super, super deep on Robinhood's earnings, going through their earnings presentation, as well as their actual 10Q, and have a lot of really great talking points here. Something that was Daniel's idea, which we're looking forward to, is we purposefully did not sync on our own opinions on Robinhood. The reason why we want to do this is have a really natural conversation. We didn't want to, not that we normally do this anyway, but like pre-decide, oh, do we agree on this? So you're going to see some real live debates on stocks. We're going to agree on some things and disagree on others, as we normally do, but the conversation will always be productive and hopefully educational for you all.
And very organic because, yeah, as Jake said, we have not collaborated. We've both taken a deep look at Robinhood's earnings, but I don't know what Jake's opinion is, so this is going to be fun.
Yeah, it's opinion that's always being formed as more information comes out.
Exactly. So do you want to kick us off then, Jake?
Yeah, I'll kick us off. And just a reminder for everyone joining, we go live every Saturday, 11:30 a.m. EST. Typically, it's Daniel and I. Sometimes we have our third co-founder, Nick, join, and we might try bringing on some guests in the future. So stay tuned for that. And as always, we're going to do stock talk at the end of the stream. All right, so let me share. Awesome. Still never trust the share thing. For some reason, you'll use it 1,000 times, but
I know, right?
Yeah. All right. So let's kick off right here. Most of us know what Robinhood is, but if you don't know what Robinhood is an investment trading platform. They went public recently, and just to read off of their own mission statement, we believe the financial system should be built to work for everyone. That's why we create products that let you start investing at your own pace on your own terms. Daniel, what's interesting and what a lot of people know is we are obviously 2 of 3 co-founders of Stock Unlock, and our mission statement is to make everybody a better investor by giving them better investment education and analysis tools. So I find it interesting that at the surface level, we have very similar missions. I mean, would you agree that at least at surface value, it seems that they're trying to help out the retail investor here?
That's what their mission statement claims. Yes,
Awesome.
I would agree.
And from knowing their company history and also not personally knowing, but being aware of the CEO, Vlad, I can confidently say that when this company was started, and maybe even today in his mind, like this is the mission. They wanted to give retail investors easier access to the market. So
I will say that they achieved their mission of giving retail investors easier access to the markets.
Yeah.
But I don't know if they've achieved their full mission.
I would also give Robinhood credit for putting pressure on the rest of the industry to lower trading costs. So I know that the brokerage I use is TD. On most stocks, excluding stocks like OTC, I get commission-free trades. So all your regular stocks like Apple, even ADRs like BABA. And I do believe a lot of that pressure came from, disruptive competitors like Robinhood in the startup space really, messing up the space. So.
Yep, I agree.
All right, so what we're looking at here is their press release. So this isn't their official 10Q, it's what the company puts out. So they highlight their financials. I almost like to think of this as the investor relations department at a company is almost advertising a business. So just going through some of the top levels. What's up?
I have a question.
What's up?
When you're looking through the 10Q, what are some of the key things you look for? And like the press release right here, like what stands out the most to you?
That's a really great question. So the mindset I have going into these is I think of companies in a few different buckets. Obviously, the most common and what you want to look for is both top and bottom line growth. Is this company growing revenues? Because if they aren't, that's obviously a problem. Arguably more importantly, is the revenue that they're making profitable? I also like to see what the management's outlook is for the business any company I invest in, I want to have a very fundamental look as to what they are actually doing. What are they building? Because you obviously need to know what you own. And other things we like to look for, or at least I like to look for, are stock-based compensation. Is management effectively using money? And especially for unprofitable companies like Robinhood, having a very good understanding of where that money comes from, because that affects us/you, me as a shareholder, if we were to consider buying shares in this company.
Awesome. Sweet. I agree with all that.
Yeah, it's like we hang out a lot or something, right?
I know, right?
Anyways, so top line went up 14%. Also, this company makes money off of transaction-based revenue, as well as users taking out margin, things like that, which we're going to dive deeper into, in cryptocurrency trading. Generally, just kind of thumbing through, things are increasing, cryptocurrency decrease. That kind of makes sense. The company lost $175 million. It also looks like their operating expenses went down. So on surface level, that's good to see, a company spending less. I know Robinhood went through some layoffs. And they are talking about share-based compensation here. I won't talk about that much right now because we are going to take a deep dive on this in their 10Q, which was a very interesting journey. But here's some things that stick out to me, Daniel. Adjusted EBITDA. So here's something investors should be aware of. EBITDA is a metric that is very clearly defined, earnings before interest, tax, depreciation, amortization. When companies do adjusted EBITDA, it's not real EBITDA. They quite literally make up their own metric. And the reason why they do this is to be more attractive to investors. I will not claim that this is always done in malice, and I will not claim that if you see this, it is automatically a red flag. What I will say, and what we are going to dive into, is you need to understand how they're calculating this, because sometimes it paints a rosier picture than what is actually happening. So that stuck out to me. Monthly active users going down. So kind of a mixed bag here. Some numbers seem like they're going up, expenses down, revenue up, but it's an unprofitable company. They have an adjusted EBITDA metric. So the next place I like to go, Daniel, is actually deep into the numbers. Do you have any questions or comments before start to thumb through this one?
Nope.
So a little bit of comic relief. Investing's really fun, right? Let's just look at this picture for a second. I'm talking about this graphic here. I've got an issue with this graphic. So I was looking at it, and first I was like, okay, every single stock's going up except for these right here. But then I realized, no, this is just transparent, and they're actually going up to him. We're just seeing the reverse side of it. So it's a very bullish day in the market over here. But more importantly, Daniel, do you see this person right here? I've got a problem with this. They're not wearing shoes. They're wearing socks. I don't know who they think they are. And right here, this isn't a foot. This is a nub. So I don't know who the artist is of this photo, but I've got questions, okay? Why does this person have a nub foot, and why is this person not wearing shoes? Just saying.
That's very interesting. You're very observant.
Definitely
I did not notice that.
Yeah, definitely didn't spend a lot of time looking at this photo for sure. Wink, wink. Anyways, we're not going to go through the financial jargon here. And this is also kind of highlighting a lot of what we saw before, but they do have a lot of really great graphs in here that kind of visualize what the company is building. This is something I want to point out, Daniel. Let's give Robinhood some credit here. The speed at which they're moving and creating features, not talking about the effectiveness of those features and if they're driving revenue or not, but at least the pace of their product development is fast. I'm not going to run through all these, but for a public company of their size to be cranking out this number of features, I will say as a business operator and engineer is impressive. And I did actually like to see that they're moving very quickly over there. So that's what this graph is showing you with all the pretty pictures.
Yeah, cool. I would agree with that.
Yeah. And so here's where it gets interesting. I want to take out my calculator here for a bit. So this is their net cumulative funded account. How many accounts are on Robinhood? And their sequential change was 60K quarter over quarter. So this is 60,000. And it's building on top of what looks like
22.9 million.
Yeah, 22.9 million. 2290 and then 1231. I think that's it. So what we're talking about here is they grew a 0.25%.
Yeah. So, all right, now we're starting to get into the juicy stuff. Robinhood has not been growing its user base essentially at all, or its net. This is cumulative funded accounts as well. Keep that in mind, right? This is not like active accounts. This is how many accounts have been funded ever, basically, right?
Yes, but even if it's not active, the money still is in their ecosystem.
That's true. Okay, yeah, that's a good call out. But still, it's not really going up. So Robinhood's user base essentially is not really growing. So what this tells me is for this company to continue generating more revenue, it has to continue sucking more revenue out of all of their existing people within their ecosystem, which means basically that their expenses got to go up or the revenue per user has to go up for the revenue for the business to continue going up because their user base is essentially not growing anymore.
Oh yeah, you are reading my mind, Daniel, because we are going to get into the revenue per user numbers, and I totally agree. This
But
business revolves around trading an account, so the fact that we can say that this number is flatlining isn't great. What a 0.25% growth, quarter over quarter, year over year, taking that 500K number, 2.2% will round up. So
yeah, but this is a huge red flag for me because there's only so much revenue that you can get out of your users before they all just start leaving. Like people know when they're kind of being squeezed. I was actually over at my mom's house last night and she was talking about how Netflix keeps raising their prices on her and like how she's getting really upset about it. And that's because Netflix is not really growing it's growing its user base, but it's not growing it like rapidly anymore. So for the company to continue growing its revenue, it's got to continue sucking out more money from all of their users, which means prices go up. And it's starting to make people unhappy. And
yeah,
people are starting to catch on to it.
yep.
So, yep, it's not something that you can do forever. You cannot just continue raising prices on people forever. So, yeah, I don't love to see that. Whenever I see a graph like that with Robinhood, I'm always just like, don't love it.
Exactly, and the similarity between Netflix and Robinhood is they're both primarily B2C companies, business to consumer. And you and I, Daniel, we're consumers. So, like you said, I wouldn't say it's easy, but as an investor, it's really good to see how our users feeling about their products. Because not to dumb this down too much, but at the end of the day, business alive to make money. If it's a B2C business, they're selling things to customers. Are those customers happy? Are they continuing to come back? Are they growing? Um,
Yeah,
so,
so this next chart right
yeah.
here is the monthly active users. And as you can see, the monthly active users are in fact declining quarter over quarter over quarter over quarter consistently. So less and less and less people every single quarter are coming back and being active on Robinhood.
And
This
it's
is not a good
consistent.
graph.
And it's consistent too. So this is 1.8 million, 1.9 million, 1.4 million. So it actually, they had lost more users in these last two quarters than they did between Q4 and Q1 2021 to 2022, which to me is a bit alarming. I'm going to bring this up in their 10Q later, Daniel, because they do mention this, citing that the crypto markets are a little bit cool and people are transacting less. So their business model is predicated on users making transactions on their platform. Obviously, that does well when the market is booming and everyone's running to the stock market. It is easy to fill in the blank there that the opposite happens when people leave. And that is what you're seeing here. You're seeing people leave. There's less monthly active users. Their net cumulative funded accounts is flatlined.
Yeah, that monthly active users is also interesting because in The Intelligent Investor, like that book is old, but how relevant it is to the markets today is just incredible because the markets are led by human emotion and human nature essentially, and that never changes. In my book that I'm writing, I actually go all the way back to the 1600s to the tulip mania, and it's just cycles that repeat by human nature. And that's what we saw over the past couple of years is when stocks are going up and we're in this massive bull market, more and more people enter the market because they see everyone else making money. And it becomes less about like, okay, let's invest in the fundamentals of businesses. We just want to like buy risky stocks because they're going up. And when that happens, a lot of people get attracted to the market. A lot of people buy stocks while they're going up. But then when stocks start coming down, you start seeing what you see in Robinhood's numbers where the monthly active users go away. People stop buying stocks as they're going down. They like to buy when they're going up and getting more expensive, which is the exact opposite of what you should be doing. Like what would be amazing to see is if that chart was exactly backwards. Is when stocks were going up, people were like, you know what, things are getting a little bit, frothy out here. We're gonna stop buying stocks right now. And then when stocks go down, that the monthly active users actually goes up. That would be amazing to see. But unfortunately, that's not how the world works.
Dude, all these humans, man. It's just humans doing human things.
We
That's
got to educate them, Jake. It's our mission.
Oh gosh. Okay. So I mean, taking it back to like investor, well, obviously we're having investor talk, but purely on these financials, like as an investor, I would like to see this number at least stop going down or understand where it's going to bottom out, because this is a consistent trend. So a company that's losing monthly active users, red flag for me. This is also a little bit of asset breakdown. Daniel, I'm not sure how much time we want to spend on all these.
Yeah,
Just
I would
we could
skip
be
this
all
one.
day. But there's another one I wanted to bring up to you, which is the revenue per user. So this is a really interesting graph. And I actually want to call out Stock Unlock, which is the company we are building. Not that we can compare to the level of revenue or users they have. I'm not going to try to do that. It's just completely uncomparable. We are a small startup. Our numbers in terms of users and subscribers are in the thousands, not millions. However, we do have higher average revenue per user than Robinhood, which is something I wanted to call out. So +1 for Stock Unlock. Sadly, we're not a publicly traded company today. But what we're seeing here, Daniel, is they did raise their revenue per user to 63, but when you zoom out, that used to be over 100. And the users that are coming are declining. And if you do the math here, while the net funded accounts is like semi going up, their net assets under custody is going down. So if you divide the net assets under custody into their net cumulative accounts, you can deduce that the average amount of money per account has actually gone down. The number of active users is going down. So even though they have squeaked up revenue per user, it's on a smaller user base. And that is just something to really be, aware of if you wanted to invest here.
Yeah, which is kind of what we talked about earlier.
Yeah.
The revenue per user is going up, which is how their revenues are going up. The revenue isn't going up from new users coming on the platform.
Yeah, and we can see here too, even like where they're getting those revenues. You talked about this. Transaction-based revenue is just them, executing trades, crypto stocks, net interest revenues. I believe is more for their banking features.
Continue going down.
One more.
Okay, so no, go up. Okay, so this is transaction-based revenue right here. This is how Robinhood makes most of their revenue. Okay, is through options trading. Well, it's actually the majority of the revenue comes from options trading. So basically, they charge people to trade options. That's how Robinhood makes the majority of their revenue. And I don't know, man. I don't know if like the majority of people trading options on Robinhood like actually know how options work. I assume a lot of them probably do, but the majority probably not. And in my opinion, I think options can be really risky if you don't know what you're doing. So the fact that like the majority of Robinhood's revenue comes from options trading, and a lot of these options traders are probably newer investors who don't fully understand what they're doing or the risk they're taking on, is a really big red flag for me.
Yeah. One storyline I see here, which is interesting to follow. Let's remember what their mission statement was, right? Robinhood, we believe the financial system should be built to work for everyone. That's why we create products that let you start investing at your own pace on your own terms. This is a double-edged sword to me, and this is just my own opinion. I think they started off giving everyone easy access to trading. The company got really big. Tons of investors got involved. They IPO'd. I want to give Robinhood a ton of credit for growing, having a crazy product market fit during COVID, and honestly, accomplishing and changing a lot for retail investors. No one can take that away from them. But my question is on their storyline, and I'm going to fill in the blanks here, is when you're a publicly traded company, you are contractually obligated and legally obligated to produce profits to the best of your abilities for your shareholders. So at all costs, no pun intended, you need to make money. And where I think the storyline gets crossed on their original mission statement is it's hard for me to see a world where you need to make money by transaction fees. Transactions are people executing trades. It's proven time and time again that the more retail investors specifically execute trades, the more likely they are to lose money as opposed to buying and holding long term. So those are two competing forces to me where it's very hard for me to see them driving up transaction revenues while still having the best interests of their customer in mind, where they're not getting burned. And that could be attributing to why we're seeing such a lack of users. Now, again, just guessing here, but kind of filling in the story here, Daniel, that's why I'm seeing. I'm curious to hear your thoughts on that.
Yep, I would agree. Go down to their next slide right here.
This one or next one?
Yeah, right here. So this is Robinhood's net interest revenues. The two largest blocks in how Robinhood makes interest revenue is through securities lending and through margin interest. Now, securities lending is shorting stocks. When you short a stock, you're borrowing that stock from the broker, and then they charge you interest on that short essentially. So Robinhood is also making the majority of their interest revenue from incentivizing people to short stocks and go on margin, which is essentially take on debt to buy stocks. So Robinhood's business, in my opinion, is they incentivize people to do options trading. That's how they make the most of their transaction revenue. And then they incentivize people to short stocks, and then they incentivize people to go on margin. That is how Robinhood makes its revenue. Okay? All of those things I think are incredibly risky, especially for newer investors who are coming onto the stock market for like the first time and investing their hard-earned money. Like those three things are what you should not be doing as a new investor. Like even as an advanced investor, shorting scares me because you can have an infinite loss. Like do they let people know that when you short a stock, you can have an infinite loss? Do they let people know that you can be margin called? I don't know. But man, red flag galore for me. I don't like it.
I can assure you folks that Daniel is not a customer of Robinhood after hearing that.
Yeah, I have some opinions on Rob. Go listen to Charlie Munger talk about Robinhood, and I am 100% in agreement with Charlie Munger. I think this is like the swine of trading.
Well, your opinion has been made clear. I would love
One more
to
thing. One more thing on my rant. Why do you think Robinhood's monthly active users are going down? It's because they don't actually create value for their users. They're incentivizing highly risky investments essentially, which means people are probably going to lose money. So if your business model is to incentivize high risk activity that most likely results in people losing money, then how is that sustainable?
I'm going to speak on the behalf of Robinhood here, Sir Opinionated Daniel. Right here on their earnings presentation, management spoke, and the reason why their MAUs decreased is because their customers are continuing to navigate the volatile market environment. I'm not putting my opinion behind whether or not I agree with that, but just so our viewers can see, you have heard Daniel's opinion. This is the opinion from management. You can make your own, draw your own conclusions from that. I'm going to hold mine to my chest on that one. But
Okay.
yeah, Daniel, I mean, really,
just continue
really
going down.
Fair, authentic thoughts, honestly.
Yeah, just continue going down. Okay.
Yeah, and got one small note, and we'll come back to this. Stock-based compensation is huge. I have a lot of notes for the 10Q, but just wanted to highlight this one and tell me when to stop scrolling, Daniel.
I don't know if you've already gone over it.
What are you looking for?
I'll check my notes.
Cool. So while Daniel's checking his notes, just interrupt me when you find it. Here's a visualization of their net loss. So as you can see, the company has never turned a profit. This isn't always a red flag. High growth companies tend to not produce profits as they invest in growth in their top line. So if you were to be an investor in this business, you should have confidence or at least see management's path towards how they will gain profitability. Because not to sound stupid, but companies got to turn profit at some point. You can't do this forever. It obviously is trending up, so not terrible to see. They're losing less relative to before.
Okay, Jake, can I share my screen?
Hell yeah, go for it. I'll stop mine.
Okay. So I have a bunch of screenshots that I took, and this one right here. All right. So user growth is 3%, engagement is negative 35%, assets under custody negative 32%. Trading. All right, here we go. Notional trading volume equity negative 35%, options trading negative 16%, crypto negative 77%. Daily average revenue per trades negative 32%, negative 24%. So all these numbers are massively down. Okay. So when I take a look at Robinhood, basically what I see is the company makes money off highly risky activities, and then they also make money off of trade frequency. So for Robinhood as a business, for them to make as much money as possible, like in a perfect world, if Robinhood is making as much money as possible, that environment looks like people trading a lot, like trading every single day, just trading and trading and trading, and taking out options, shorting stocks, and going on margin. That would be the ideal environment for Robinhood to make the most money possible. And then I got to ask myself, is that an environment that I want? Is that something that I want to own? Is that something that I even want to see in the markets? And my answer is a hard no. I think this company makes money off of like highly speculative activities and promoting that to people. And I don't think that's going to last. I think it's wrong. I don't agree with it. I don't like it. And yeah, I think this business does not create value for its customers at all. It destroys customer value, which is a failing business over the long term. And I think we're going to continue seeing that. That's why they're losing users.
Yeah. For the sake of debate, I will take partial the other side of that. Robinhood has done a lot for this space historically and have really changed the landscape around how retailers can trade, lowering costs down to almost zero. I do think that they might be caught in a little bit of crosshairs here, where I do see the points of a lot of what you're saying, but looking towards the future, I do think that management is looking to diversify their revenue streams. On that note, Daniel, I did have some notes from their 130-page 10Q, so our viewers don't have to read it, but I have some really interesting talking points to kind of wrap this up until we, I think, go to NSA REIT. How do you feel about that?
Do you have like the best of the best talking points? I kind of feel like we've talked enough about Robinhood, honestly.
Yeah, let me read from my notes here. So Robinhood bought a company called Ziglu, which is a cryptocurrency company. They originally were going to pay around 170 million and renegotiated the price down. Another thing we have not looked at is the amount of share-based compensation they're doing, as well as their projected outlook for the hundreds and hundreds and hundreds of millions of dollars, upwards of billions that they are doing in SBC. They have notes about legal matters and actually defining their adjusted EBITDA, and their adjusted EBITDA does not include stock-based compensation or depreciation amortization, which is actually directly from the original definition of EBITDA. So those are some of my notes. I have a couple more, but yeah, down to move on if you are.
Yeah, I want to move on.
Let's move on.
Robinhood. I
This
think
is one of those things where I could nerd out on that earnings report forever. Yeah, talk to us about NSA, because you were using the stock unlock screener, I believe, to find that stock.
This is a good comment. I always loved the opposing view. If it wasn't for Robinhood, retail investors would be paying hefty commissions and many of us wouldn't be here. So stop bashing them. I agree. And that's what Jake is saying, is that, they kind of changed the retail landscape and made investing accessible. And that's why I said at the beginning of the video, I do agree that, they did change the landscape. They did do some positive things. But when you take a look at their business model and how the company actually makes revenue, it goes against people's best interests. Also, the reason that they can make investing free for everyone is because they're selling the trade data to major banks and brokerage firms so that these brokerage firms can see what retail investors are buying and selling every single day so that they can bet against you. Like, I understand, and I do agree that they made things cheaper for retail investors and put pressure on everyone, but the numbers don't lie. How they make money is sketchy, and it's like it does go against people's best interests, which is why they're losing so many users. That's my opinion, at least. So
your opinion is clear.
Anyways, let's move on. All right. Is REITs Part 2 out tomorrow? So recently we did a live stream on REITs, going through them. The reason that I have not made Part 2 yet is because a lot of the REITs, I didn't even know this, but a lot of the REITs reported earnings within like 2 days after I made that video. So the next step of that video, the live stream, is to go on the Freeform tool and start comparing all the different metrics on the REITs to see like which one's growing the fastest, which one has the best price ratios relative to growth and everything. But since they all just reported, that data will not be in Stock Unlock for a few days. So I can't actually make that video with accurate, up-to-date information until, we get that data in. So I'm going to wait for the data to come into Stock Unlock, and then I'll make the second part of the REIT video. Okay. There's a lot of stock requests. Jake, do you have anything?
I thought you were about to go through NSA, but if we're
No,
going to
I'm not going to go through NSA. No, I'm going
okay.
to go through that in the REIT video.
Okay, cool. So we actually did have, I'll share my screen. We did have someone who emailed us 2 stocks to look into. So I think that's a good place to start. So I'll just share the message. I did look at them a little bit. Let me bring up the image here. So can you please review Salesforce CRM and Procept PRCT on Saturday? And then a little bit of a note. I actually think Procept was an interesting company. So Daniel, I'll share my screen for that one. But just the brief from the Stock Unlock subscriber here. It is a new healthcare device maker for the treatment of BPH, enlarged prostate, an extremely common problem for men. I am a urologist, and this is an excellent innovation for the surgical management of BPH. So one thing I'll say for sure is investing in any companies, find your niche. If this person knows a lot about urology, you should probably be investing in this space. I want to give a disclaimer. I'm really out of my comfort zone with this business landscape. So I'm going to look at their financials, but I'm not going to be able to speak much about who their competitors are and really like why their product is so unique. So I would never invest in this company, even if it's the best company in the world, because I only invest in things I understand. And of course, I just closed the window instead of opening it. But yeah, let's head over to Stock Unlock. Daddy, what was the PRCT? Yeah, okay, so Procept Biorobotics Corp. So here's the things that stuck out to me, Daniel, when I read this. Looks like this company IPO'd recently. One thing that I actually liked is most companies that have IPO'd in around 2020, 2021, have we seen are heavily, heavily down from their highs. This stock is actually pretty flat. I think right now they're at about -4%, but you can see it's kind of hovered. So I do like that this stock has at least maintained some of its value. Another thing that caught my eye right away is the stock has a 35 price to sales ratio. So let's just think about this purely on a financial basis, Daniel. $1.7 billion market cap. Let's look at how much revenue this company made. They made under $17 million last quarter. And if you tally up the trailing 12 months from the latest data we have in Stock Unlock, might not have the latest report yet, it looks like we can round up. They made $50 million in revenue. That's not profit. That's not what they're taking home. That's top line revenue. So to me, this stock is going to need to grow its sales immensely to catch up with this evaluation. And the people who are buying this are pricing it as if it will do that. So it does look like a growth stock to me. Any comments on this one, Daniel? I was going to run through insights, but those are
Yeah, so typically when I see a stock like this, the reason that I have not taken a look at this company's financials at all, but the reason that I would assume the valuation is where it is with a 35 price to sales ratio is because their balance sheet probably has a lot of cash on it. So it might be trading near asset value. And you can see right here in our insights that their financial position is very strong at a 4.6. They have cash runway of 4 years. So if you go to the balance sheet quick and you go to their current assets, they have, yeah, so this is another thing is when companies are not profitable, we talked about this a lot in our live streams, but when companies are not profitable and they're losing money, they burn through their cash position. And if you click on total cash again, that's exactly what's happening here. So they did their IPO last year. They raised a ton of money. It looks like probably about $200 million. And then now, since the company is unprofitable, they're starting to burn through that cash. Why this is risky, one, is because, I mean, cash is oxygen for businesses. So if the company does not reach profitability before they run out of cash, they're going to have to dilute or they're going to have to do some sort of debt, which is, it kind of destroys shareholder value. So that would definitely be something to watch out for.
Yep. Yeah, I guess I can end this one with, again, I would never invest because I don't understand the business. But like you said, Daniel, they have way more than enough cash to run. They're slowly burning through it. They have a high eval. So as an investor, you have to ask yourself, are they going to grow into that evaluation? And do you believe in the technology and management of this company and the ecosystem they operate in, where they will become a leader / gain enough market share to start returning money to shareholders? It's unclear to me, but definitely looks a little expensive just based on a purely fundamental analysis.
Yeah. I would agree with that. All right, Jay, can I share my screen quick?
Of course. Daniel, you can share your screen whenever you want.
Thank you.
And totally up to you. One other stock there, which is totally optional, is Salesforce, which had really great revenue growth. It's a big company to chat about. So just throwing that bone to you if you want it.
Yeah, so I think we've actually talked about CRM on the live stream before, but they reported Q3 not too long ago. So I'll go take a look. I have not taken a look at the stock recently. So right away, Salesforce, like this company is absolutely massive. Over the past 18 years, it's up over 3,500% versus the SPY's 218%. So massively outperformed the SPY. Also, if we take a look here, the stock is currently down over 40%, over 50%. Wow. Okay. So it's down over 50%. This is, again, a massive company worth about $140 billion. It's actually close to Adobe's valuation right now, which is super interesting. But whenever, just me as an investor, whenever I see a company like this that's massive, it's a great company, it's continuing to grow, fundamentals are going up, but the stock price is down 50%, I always get interested. I don't know if the stock is cheap yet, but it always piques my interest. So then I would like to take a look at the revenue. We can see that the revenue, like, look at that, man. That's ridiculous.
It's a beautiful graph.
That is an absolutely beautiful graph. Like, holy, revenue is at an all-time high right now. If we take a look at cash flow. So yeah, this is the thing that I've been wondering with Salesforce, though, is revenue growing is great, but what makes stock prices go up over the long term is if the company can grow its profits. And Salesforce, since about the first quarter of 2021, has been struggling to continue growing its profits as revenue has been going up. And what that means is its operating cash flow margin is going down. So less of the revenue is becoming profits for shareholders. So this company, in my opinion, has to start getting margins back up and getting profitability back up. And when it does, then I think the stock price will start recovering in a big way. But you can clearly see that, like, the market doesn't really care as much about the revenue growth right now. What it will care about is the profit growth. Now, I don't know enough about this business to know if they're going to increase efficiency in the future. I imagine they probably can, because typically large businesses like this, they have so much resources. Like, they're a massive company with so much resources that I imagine they will be able to increase their efficiency. I just don't know how. I would have to take a deeper look into that, which is why personally I wouldn't buy it right now. That's just me, though. But if we go and take a look at the stock price ratios, and we take a look at the price to operating cash flow, I mean, over the past decade, their average has been 33.35. Right now, it's 23, if we want to round up. So the price to operating cash flow right now is well below its historical averages. And we can even see right here that during the stock market crash of 2020, the price to operating cash flow got down to 27. Right now, it's 23. So its price ratios are below when the stock market crashed in 2020. So yeah, I mean, if this company can continue growing its revenue and figure out a way to get its actual cash flow growing again, because you can clearly see revenues going up, but cash flow is just not. If they can fix this issue, then I think it could be a super interesting stock.
Yeah, I think some higher level thoughts here. So I've worked in corporations before. I can say Salesforce runs rampant through the corporate industry. They have extremely sticky products that a lot of people are trained on. So even on like a job resume, you'll see people trained or certified in Salesforce technology and products. So historically, they have had a really great business model, a lot of great customers. One thing that I'm curious to see is, I know we've been talking about marketing spend, Daniel, and in the recession, like, companies are spending less money. I don't know the answer to this question, but for someone looking to invest, I think it would be really good to look to understand who are their customers and are they going to lose revenue during this market downturn because businesses aren't able to pay as much or they go under. Businesses who are direct customers of Salesforce would be interesting to check out.
Yeah, I agree. So Sophie.
Hi, Sophie.
Yeah, Sophie's here. And she asked me to take a look at, where is her comment? Where did you go, Sophie? Right here. Okay, so Sophie is in my personal Discord. Been there for a long time. Thank you so much. And she said, I heard you, Daniel, mention dental in your Discord. So can you tell us more? Yes. Full disclosure, I own this stock, okay? So just know that before I take a look at this stock. So I am bullish on this company. I own shares. This is not advice to go buy the stock. Please do not go buy the stock. I'm just going to kind of show you guys what I think.
I do not own shares, so I'm going to be looking out for things to grill you on, and we'll take it from there.
Sounds good. Okay, so this stock, and I own a very, very, very small position, okay? So not a huge position at all. It's just a little fun position, okay?
A little appetizer stock for your,
yeah,
for your
tiny,
buffet.
a little nibble of the stock, if you will. And it's actually down a lot, though, since I bought it. So might have to, whatever. Anyways, so this stock IPO'd last year in 2021. And basically all stocks that have IPO'd are down a lot. It's now down about 50% from its IPO price. It's down how much from its all-time highs? Down 62% from its all-time highs. It's a smaller cap company, $1.3 billion valuation now. And what this company does, okay? What this company does, they own dental offices across Canada. Okay? That's the business. That's it. That's what they do. And what they do is they take their profits and their cash flows from their existing dental offices, and with that cash flow, they go and they buy more, and that's how they grow. So the thing is in Canada, the dental offices, like there's no overarching network or business that owns like the majority of the market. All the dental offices in Canada are privately held by just like, entrepreneurs. So in my opinion, there is an absolutely massive market for this company to go and just continue expanding into and just continue acquiring dental offices across the country. And when they
Daniel, I have a question about what they do. So do they actually employ the dentists, or do they own the dental office and then the dentists then like pay a kickback or like a rental fee?
No, they buy them outright, and then the owner becomes an employee essentially. But they pay them, they buy out the company, the dentist stays an employee, and then they have a track record of whenever they acquire a dental office, they increase its efficiency by like 25%. They, do their marketing strategy, they increase revenues and everything. So like they acquire, they make it more efficient, make it more profitable, make it more cash flow, take that cash flow, go buy another one, do the same thing. And that's just how they expand.
So I'm curious, you've done a good job explaining like what they do and showing that the stock prices went down. What specifically did you see that made you invest in this company? Because I know that you are a cash flow investor as well as like understanding businesses. I do have a side comment after all this, just for like a little fun debate about the business itself. But like before that, though, very curious just to get like a really quick top down, like Daniel Pronk, why did you invest in this company?
Okay.
Oh, he's got the Gatorade bottle out. We're going.
No, okay. So this company just became public, right? So we don't have a ton of financial data on it, but you can see that their revenue is growing like super well. It's not like the most consistently growing revenue, but revenue is overall trending up. If you take a look at the trailing 12 months, it is now at an all-time high of about 1.3 billion, and the revenue is growing like 6% quarter over quarter. So revenue is growing. Awesome. Now, if we take a look at cash flow, you can see that the cash from operating activities is also growing. In the most recent quarter, they've done about 51 million in operating cash flow, and that's going up. So the business is making more and more cash flow. And then if you take a look at CapEx, their CapEx to operate the business is only about let's round up, $8 million a quarter. So if they're doing 51 million in operating cash flow, $8 million in CapEx, then that means that their free cash flow in the last quarter was about 43.2 million, and it's growing quite significantly now. Since this business is also growing like this, what I like to do is annualize this cash flow, because it is consistent cash flow that's coming in and it is growing. And so basically what I'm trying to say here is like every quarter going forward, they should probably be doing about $40 million in cash flow. They're not really going to be doing, $20 million in cash flow anymore. Like this is the company's new normal. So what I like to do personally is annualize this. So let's just say 43 times 4 quarters is about 172 million in annual free cash flow. Awesome. Go over to the general tab, you go to $1.3 billion valuation. So 1.3 billion divided by, let's say 170 million in annual cash flow is a price to free cash flow of about 7.6, which is pretty dang good. So I think that, like, I just think, this company is so boring. Like its name is literally Dentalcorp, right? I don't think anyone's looking at it. I think it's like a really big Peter Lynch investment. I found it. Um, I liked it. I like the numbers. I like the growth. The management owns a lot of shares. They're buying more shares as the price goes down. I just see a super great runway for growth because like the dental industry in Canada is so fragmented. It's not consolidated at all. So there's a huge growth opportunity there. Like I was just like, you know what, man? I like it. I think it's cool. I think it's cheap. One thing you got to know about the business though is that it does have a history of doing dilution. So I believe the cash flows are up something like 100% year over year. But when you take a look at the free cash flow per share, it's up like, I think 30% due to the dilution. But free cash flow per share is going up, just not as rapidly as the overall cash flow. So if you're someone who doesn't like dilution, definitely look into that.
Awesome. Well, that definitely answers my question as to why you want to invest. I have to agree. It is nice to see that operating cash flow and then annualizing it is cool. So give me the liberty here, Daniel, to push back and ask you a question, kind of pushing back on your investment here from an ideological standpoint. So you made it very clear before when we were going over Robinhood earnings, you have opinions and you have opinions around businesses and if they're doing good or bad for their customers. So you are an entrepreneur. You said most dentist offices are owned by entrepreneurs. So I'm going to be a little bit of a reporter here, so you can push back, but let me get this out. You are harming entrepreneur dentists by supporting a company who is buying them out. So as an entrepreneur yourself, you are investing in a company that is buying out dentist offices that were ran by entrepreneurs and putting it under the umbrella of a corporation. Point number two, and I'm almost done, for someone that used to work in healthcare outcomes are incredibly important, and the client-patient relationship goes beyond money, and it should be something that's very personable. So I'm curious if you looked into if this dental office, in addition to increasing efficiencies, is not decreasing patient outcomes, because it would be a shame for a money-hungry corporation to come in and ruin dentist offices where they're more profitable, but now not as helpful. Again, just saying this for the sake of debate. Feel free to reply.
No, that's a good debate.
Yeah.
Because people don't. There's like this stigma, a corporation comes in, buys out the company, and then like prices go up, everyone's unhappy, right? So for your first point, entrepreneurs selling to this company, one thing, they don't have to sell. Like no one's, like you have to sell us your business, right? These entrepreneurs are choosing to sell their company to this corporation. So it's not like it's the entrepreneur is like, yeah, I'm out. I want you to buy me. I want the money, and I want the salary. I want to become your employee basically and get that cash. So yeah, that's my rebuttal there. The second point is, yes, I have looked into the customer reviews, and I believe that their customer reviews go up once they're acquired because they make the business more efficient, and they can invest their. So, for example, they could take their profits from their network of other dental industry or their dentals and take those profits and then invest in new equipment at a new dentistry and actually like make that dentistry have more services for people or better services for people with like newer technology or the best equipment out. So, yeah.
Very fair. Yeah. I'm not surprised that you've done a lot of thinking about this. I think it's great that you looked at the customer reviews. And for people watching, those are all the things I'd expect any investor to do. It's not just financials. It's also, what is their business? Does it have a positive impact? And it does feel good when you can use your dollars too as an investor to impact, good businesses.
I actually have, I have a comment that I think is on theme for today's live stream. When you're investing, I think it's a good idea to ask, how does this business provide value to, the people that it's serving? So when we looked at Robinhood, they did provide value in offering free trades. I will give Robinhood that. They changed the game for free trades. But now I think that the company is not really providing value for its customers because, it's kind of working against their best interests. Then you go over to dental and it's like, okay, how is this business providing value to its customers? How is it increasing value to its customers? And as we just discussed, how it does that. So I think that is an important aspect of investing to consider and think about is like, how are the customers and the clients of this business actually getting value from it, you know?
Yeah.
And is there value being created in the first place?
And as always, if there's anyone in the chat that has comments on what we're talking about or a different viewpoint or something else for us to, chew on, feel free to throw it in the chat. We love interacting with you all. Yeah, that was a great one. I mean, great point. You want to, should we go through and pick a stock for stock talk here? What are you thinking, Daniel?
Yeah, so Patrick Boyer says, Daniel, what are your thoughts on Dream's recent earnings? I thought they were great. I don't know why the stock is down so much. I don't get it. I'm owning my shares. I would not, personally, I'm not thinking about selling a single share. So whenever companies report that I own, what I do is I go through the reports and everything, and I take my own personal screenshots. Like, I don't know if I'll ever do a video on Dream or discuss it really in depth, but what I do is I, again, just take my own personal screenshots and figure this out, and just for my own records, right? So I'll show you some of the screenshots that I took from Dream's most recent earnings. So this right here is like an overview of the company. And right here at the bottom, I'll zoom in. This is the net asset value per unit. This is also known as the book value per unit. And up here is 2020. So the time goes from right to left, left being most recent. And you can see that back at the beginning of 2020, the company had a book value per share of about $12.55. The share price was about $13. So it was trading for above book value over in 2020. You can see that the book value has consistently gone up. In the most recent quarter now, book value per share is $17.05. But the share price has gone the opposite way. The share price is now $10.73. This company is now selling about 45% below book value. I don't get it. Like, book value is going up. Its cash flows are going up. Its revenue is going up. Everything is going up, but the stock price is going down. So even take a look at their occupancy rate, okay? Like, this is a REIT. Their occupancy rate in 2021 was 97.2%. Their occupancy rate has been trending up to 99% now. Like, I don't get it.
Damn.
Yeah, I don't get it. It's like every fundamental metric that I care about is going up while the share price falls. So, yeah, I've been buying it. I'm holding it. I'm happy with it. I think the company is performing great. And if the market wants to give me cheap shares, that's fine.
Awesome. Have we talked about, I might mispronounce this, Innovalis REIT? Innovalis REIT? Oh, gosh. I'll see if we have that one. I haven't heard that one yet.
This one, eno.un. I don't think we have talked about that one.
Yeah, it's trading at $4.11 a share with a 10.04% dividend and a 2.19 insight score.
Yeah, and a FFO yield of nothing. So this company does not have positive FFO.
Yeah, let's dive into this one a bit because, Daniel, the first questions I ask myself when looking at a REIT is how safe is the dividend, like, and also like who are the tenants, right? So curious to answer all those questions.
Okay, so first off, the first thing that I always like to do whenever I take a look at a business or a REIT in specific, especially REITs, is like, okay, it's a REIT, but what kind of REIT? Like, what does it do? Is it an industrial REIT? Is it a self-storage REIT, office REIT, diversified REIT? Like, what is the business? Like, what is the real estate that the company actually owns? So when we go down here on Stock Unlock, we can see right away this is an office REIT. So it owns office buildings, and the company owns interest in office properties in France and Germany. So it owns office buildings in Europe, essentially. Now, the reason why I don't love office REITs right now, I don't own a single office REIT, is because work from home. I'll give an example in my hometown, Calgary, Alberta, Canada. Our office vacancy rates are at like 30-something% right now. So basically 1/3 of the office real estate in downtown Calgary is vacant because of the work from home policies and companies understanding that, like, they don't need nearly as much office space as they historically thought because they can run efficiently with their employees at home. And a lot of employees prefer working from home. So I think there are massive headwinds on office real estate right now. And I imagine that if we, like, it's got an insight score of 2.19, which tells me there's some red flags going on. And if we take a look at their quarterly revenue, like, it is downtrending. It kind of had a boost right here. But if we take a look at the trailing 12 months, revenue is declining. It's declined by like 15%, it looks like. And if we take a look at operating cash flow, their operating cash flow is now negative. So the company isn't actually generating any cash flow in its operations anymore, which sucks because they're also paying a $36 million a year dividend while losing money. So how are they paying this dividend?
Yeah, I just don't understand that, because it's like the most logical answer is, are they taking out debt to pay it? Like, are they sitting on cash reserves from past activities? I rarely see people do stock dilution to pay a dividend, but I mean, is
It
that
happens.
clear in the financials?
They did $50 million of dilution at the end of basically in 2020. But yeah, it's interesting. Like it is interesting. But this is a good example of a stock that I think is very risky. I don't think this dividend is sustainable. It's attractive. I mean, you look at a 10% dividend and you're like, sweet. But again, I don't know if that's sustainable. And I don't know. Here we go. I will tell you one office REIT that I have owned in the past that I do not own anymore, but I think is interesting because all of its tenants are basically like TD Bank. And I think they have something like 46% of their tenants are governments. So, pretty sustainable businesses, in my opinion. Like the government's not going anywhere.
Daniel, just to interject a bit, the person who asked this question, I'm going to try to pronounce the name, Eamon S. Thank you for that. Company operates office in Europe and is undergoing asset rotation. The dividend was also recently cut in half, which tumbled the shares. Some good stuff.
I think that's a good call for the dividend to be cut in half. I think the company did the right thing there, but it's still losing money. Even if they cut the dividend in half, how are they going to pay it when they're losing money? So
that makes sense.
And the revenue is declining and things are declining. So it's just like, I think there's a lot more high quality REITs out there, in my opinion, than that one. And I'll show you this office REIT. So this one has, a dividend yield of near 10%. It's got an FFO yield, though, of 15%. So the FFO covers the dividend. If we go and take a look at the financials, the revenue for an office REIT, you can see the revenue is like intact. It's actually growing slightly, but the revenue is intact. The revenue is not going down. If we go to cash flows have declined slightly, but they're starting to uptrend back again, and it is producing positive cash flow. And if you take a look, the operating activities produced about $82 million in cash flow. The dividends are about 49 million if we want to round up. It's actually about 48 million if we want to round down. So the operating cash flow clearly can cover the dividend well, like perfectly fine. So I think this is a business right here. It's a REIT where the dividend is intact. It's a nice dividend yield, and the FFO covers the dividend very well. Also, I believe the founder of this company, his name is Daniel Drimmer. He owns a large portion of the shares, and he consistently buys more shares in the business. So this is another office REIT right here with a similar yield, producing actual cash flow. Revenues are not going down, cash flows are not going down, and the cash flows cover the dividend very well. So that's what I mean. Is I think like when you compare this stock TNT versus INO, it looks a lot less risky to me. And you get, well, if they just cut the dividend in half, now you're getting a double dividend on a more stable business, in my opinion.
Yeah. I mean, just simply put, right, it's like if a company's paying a dividend, can they afford to pay this dividend? Like everyone should be like, if you own a stock that's a dividend paying stock and you can't answer that question, look at the company's financials and start answering it for yourself. Just things every investor should be aware of.
Yeah. And like, I could be wrong. This, like, as Eamon said, they're going through an asset rotation. Like maybe they're reworking the business. Maybe things will change in the future. But right now, I think like I see a lot of red flags, and that's me being 100 with you. I see a lot of red flags.
Yeah. And I know we're going back and forth here, but this is also where very good investors, smart people who are patient, find great opportunities, because on the surface level, I agree with your claims. However, every story is different. It is not impossible to theorize how there could be something changing in management, different business operations going on, of revenue streams they'll launch in the future, where smart, savvy investors might look at this and say, I disagree with the market. I actually think they're going to turn this ship around, and I'm going to use this opportunity to start a long-term position. Of course, we're not saying that is happening here, but just to be fair, always an opportunity. Daniel, if you're down, someone recommended stock IEP, and I pulled it up. I can do a little quick analysis on that one. It's an interesting one.
Yeah, sure.
All right, so Marcelo, thank you so much for being here. IEP, let's take a look. Share my screen here. And Daniel, not to make fun of you a bit, I know when you were live streaming, there was a couple of times you forgot to share the screen, so I'm happy we have each other here today to. Yeah, it's hard because like when you're not sharing, you think you're sharing, so you don't see the chat anymore when you're only working on one screen, all that stuff. Anyways, IEP, ICANN Enterprise LP. Full disclosure, this is the first time I'm looking at this company, and this is not a full analysis at all. I'm just calling out one quick thing I saw with them. So off the bat, just like kind of reading their quick stats, 14% dividend, 17% free cash flow yield. So those are pretty good numbers there right off the bat. They're able to pay the dividend with their free cash flow. So that actually looks good. It makes me want to dig a little bit more. When I scroll down here to see what the business does, I read it before, almost 20,000 full-time employees. And this is a holdings company. So it seems that they are comprised of many various private companies, which they buy, which span, it looks like energy, automotive, food packaging, the list goes on and on. So right there, I get a little shaky as an investor. So this is just personal for me. The investments I like to do, I really like to understand the company and what they do. This is a company that is comprised of various companies, which to me drastically complicates the investment process since you would have to look through all of them. So for these types of companies, what I like to look at is, do you trust the person managing it, and are they managing the business well? One thing I saw that I did not like, and this is what I wanted to call out, is I looked at their revenue. Their revenue is pretty flat. Don't really know what happened back here, but relatively flat. So the thing I then looked for is, okay, well, how's the shares being managed? This is bad. In my opinion, and maybe you need to look deeper under the covers, someone could correct me here, but generally speaking, when people issue shares, it is diluting current shareholders. This company is predictably, so maybe that's a good thing, you can predict that they're going to do it, diluting shareholders 7% year over year. So even though their revenue looked like it was flat, if you go and look at their revenue per share, it is going down relatively to the past as they continue to dilute the stock. So again, we're not going to have time to do that this stream. I'm not sure exactly where it is. You'd have to go to their investor relations website, but why do they dilute so much? And also, like, do you trust the people running this company? That was, I guess, what I'd call a red flag, but insiders seem to be buying it up. So maybe they know something I don't. And for whoever brought this up, I'd like to hear anything else in the chat. What's up?
Jake, that was a very good analysis.
Oh, I thought you were going to say you just talked way too much.
No, seriously. Like, you were talking about the share count going up, and then on my screen in Stock Unlock, I was going and taking a look at the revenue per share, and then like that's the next thing you did, and I was just like, beautiful.
we hang out too much.
We have some questions here. So Nick has asked this twice now, in all caps, by the way. When are we getting the scanner?
Annoying answer, never, because it's a screener. Hope you don't hate me after that one. I'm an engineer, so I can speak to this a bit. We are beta testing this. If you are a subscriber to Stock Unlock, you can access the screener today by joining the beta testing crew. And the purpose of that is just help out test out. You get an early buggy feature that we build together before it's ready to ship. So if you are, Nick, a subscriber to Stock Unlock, we would love to add you to that group. Reach out to support@stockunlock.com, and you can access it early. And you're welcome, Marcelo. Not to jump around too much, but yeah, that was a fun stock to look at. Obviously, a lot more to peel off the onion there, as they'd say. But
yeah. So VJ asks, "Hi Daniel, what's your thoughts on recent analyst downgrades for EQ Bank?" I didn't know that they downgraded the stock because I don't actually pay attention to what analysts say. I don't know why they would downgrade it though. The company reports earnings within the next, I think they report this week. I own EQ Bank, by the way. full disclosure. It's a pretty large position in my TFSA because the company right now pays a near 3% dividend, and the management is projecting to grow the dividend by 25% annually out to 2027, which will result in a dividend yield of near 9% if they can execute. So it's a great dividend growth stock, in my opinion. However, with that being said, rising interest rates harm Equitable Bank in the short term and actually cause the revenue to decline, which is contrary to most banks because you think interest rates going up, they should be making more money, right? This is not the case with Equitable Bank because what they do is they offer the highest interest rates on deposits in Canada by far. It's not even close. So when interest rates rise, they immediately start paying more money on the deposits that they have in the bank, which is an expense for the company and it causes revenue to decline. And then over the long term, while interest rates are up, they slowly start offsetting that by increasing the interest rates on the loans that they do. But again, you have that immediate cost of their deposits going up. So immediate cost versus like long-term benefit. That's why when interest rates go up, their revenue actually goes down and it's more of an expense for the company in the short term. So what you should expect for Equitable Bank in this upcoming quarter is probably revenue to go down again for the reason that I just said. And do not be alarmed by that. That's just what's happening. It's going to happen. I'm okay with it personally. As a shareholder, I'm fine. I'm expecting it. So what I'm looking for is the book value increasing? Are their loan loss rates remaining low? They have the industry standard for lowest loan loss rates. They have the best portfolio, in my opinion. Is the dividend still going up? Is the management still optimistic? And what was the other metric? Oh, are their customers continuing to grow? Because they're growing customers at a rate of like 20% or something like that year over year. So they're actively attacking the major bank moats in Canada, and it's working. And they're stealing a ton of customers because they have the highest interest rates on deposits. So that's my thoughts on Equitable Bank. I'm a very happy shareholder. I track the insider buying on the stock consistently, and what was I going to say? Oh, yeah. The largest owner of Equitable Bank owns over 20% of the shares now, and they actively buy millions of dollars worth of shares consistently. Like as the share price falls, insiders continue buying. So I think it's cheap and I'm happy with it and I'm going to hold it.
Not financial advice.
Not financial advice. Don't go buy that stock, by the way. Do not buy it. Do your own research.
So I like throwing you bones, Daniel, to see if you want to try to catch or not. Here's one. I think this one's from Vijay asking us to compare BJ and Costco. I actually, like, we could pull them both up in the freeform tool and do some analysis on them in there perhaps, but they say, I know many who instead of Sam's Club and Costco hold BJ membership. However, I don't think they have any presence outside the East Coast. Could be a fun one. I looked at their revenues. It's like Costco revenue compared to like BJ's revenue is like comparing a mountain.
Yeah,
like
I know. That's why I think we should add percentages to the freeform tool. Like instead of taking a look at the net revenue, like have a percentage button, then you can actually like they both start at 0%, and then you can see like, okay, which company is actually growing revenue faster, like very clearly. That will come.
Let's do it.
We'll do it. Before we talk about BJ, there's quite a few questions about utilities in general. Like this person, I don't know how to pronounce that name, so I'm sorry. But Daniel, you have talked positively about BEP in the past. Can you take a look at it from Stock and Lock's perspective? So many of the key metrics look bad. What's your take? And then Ralph also said, can you explain to the group what Stock Unlock is doing with utility metrics? So when you go to Stock Unlock right now, and if you go and take a look at, for example, Fortis, which is one of the largest utilities in Canada, has an insight score of 2.78, and we say that it has a cash runway of 6 months, which basically we're saying the company's going to run out of money within 6 months, which is not going to happen, okay? It's Fortis. It's, again, the largest utility in Canada. So what we have realized is our insights right here. Let me back up. What we realized through like extensive research on utility companies, like a lot of research, is these are not the right metrics for utilities, because utilities have their own metrics that apply to them and other metrics that investors should be focusing on. So right now we're applying our insights from like tech stocks and all those other stocks in the market on utilities, which we have learned is not actually the right thing to do. So what we're going to do is we have a bunch of different metrics that we're going to be applying to our insights for utilities in specific, so that we can more accurately grade them on like what we should be grading them on. And those metrics are all written out. They're all ready to go. We just have to add them in, essentially. It's just a matter of coding them in now.
So this is fun, very live stock and lock development, real business conversation here. Daniel, if there's any metrics for utilities that we should not be showing, it is a 2-second code change to remove ones we are already showing. It's obviously not 2 seconds to add new ones. And as you said, prioritization station over here,
Yeah,
as always. But yeah, let me know if there's any that we should yank. Like if the cash runway shouldn't be there,
it should
pop
not.
it out.
It should not. I'm
All right. Well,
Nick,
Ralph, expect some of those changes to land very shortly. But for the new ones, I think Daniel's right that we are constrained on engineering resources at the moment.
They'll be out before the screener, because for the screener to work 100%, our screener is still in beta testing. And for the screener to be the best possible screener that we can make ever, this has to be fixed. So me and Nick are collaborating very closely on the screener, and Nick knows about all these issues. I have a doc that I made for him, all the changes we got to do, all the new insights we got to make, and he's going to code them in for sure before the screener is released. So I would say within the next 2 to 3 weeks, the utility insights should be revamped and much more accurate and a lot more high quality. And yeah,
awesome.
I'm stoked.
Daniel, I hate to be this person because these are, I could honestly do these for hours with you. I think that there are people, one of which is my partner who lives with me, maybe coming back here in like 5 or 10 minutes to live in a very, very small New York apartment. Maybe we'll do one more stock here and wrap it up. How do you feel about that?
Yeah, sure.
We've got one here from Bijka. Sorry, it's so many consonants at the end. It looks like a Canadian one, NVEI.
Yeah, that's Nuve. I would prefer not to talk about that one. We should talk about BJ, the one that we were going to talk about before, but then I sidetracked us. So yeah, we should go back to BJ.
Cool. Let's go back to BJ's. Maybe we'll save Nuve for another stream.
Yeah, that company, I know about that company. It's just super complicated. They're like a global payment processing company. They did really well during crypto, like the crypto boom, but I don't know how the stock is doing now. Like a very technical stock, so it's hard to understand what's going on there. Okay, so we're taking a look at BJ now. It's a retail company. I believe the chat said that this is like Costco.
Oh, so I'm familiar with BJ's. I live in New York. One of my friends used to work there. Yes. Sam's Club, Costco, you buy a membership and they have huge airplane hangar sized stores, and you can get things on the cheap, and in bulk. So they have, I'd be curious to see how loyal their customer base is. I'd expect this company to have pretty consistent revenues, which is making a lot of assumptions actually. So we'll verify that. But yeah, their competitors would be Costco, Sam's.
Cool. Okay. So right away I'm seeing if they're,
that's one of my favorite features. This was actually spawned before the screener. So people were like, I want to be able to compare multiple stocks insight scores. And then we added this one. And the response was, well, I want to do as many as I can. We're like, all right, we're going to go back to the drawing board. but this is still a great one.
Yeah. Okay. So we're taking a look here. The stock on the left is BJ's, and then the stock on the right is Costco. So if these companies are similar, let's compare the insights really quick. So for the financial health, current ratio is lower on BJ's. The shares are going down, so they're buying back shares. Costco has less debt to EBITDA. BJ's has more intangible assets as a percent of total assets, so they may have done some acquiring historically. They also have a negative tangible book value. So yeah, there's some goodwill and intangibles on the balance sheet for sure. In terms of ROIC, Costco has a ridiculous ROIC of 35%. BJ's is still basically 31%. That's incredible. That's really good.
Yeah,
Yeah, that's really good.
that's cool.
So ROIC is basically like the company taking its cash and investing it into growth. And then this is the return that they get on those investments. So a 30% return on invested capital is really good. ROCE, 17.5%. Costco, ridiculous, like 25%. Return on equity, 57 versus 28. Return on assets. So in general, I would say Costco is better at deploying capital, but this is still really good. Like, don't get me wrong, this is still really good. They don't pay a dividend. Costco pays a dividend. They're both profitability scores of 2.4. Gross margins. BJ's has a higher gross margin. Operating margin is about the same. Net margin is about the same. Free cash flow margin is about the same. Cash conversion is good. Growth. BJ's has a better growth score. Revenue is increasing by 0.06% more. Gross profit, operating income about the same. Net income about the same. Well, a little bit better. Operating cash flow is growing at BJ's. Free cash flow is decreasing on both. Book value is growing. This is super interesting. These companies are actually like very similar.
Well, I mean, yeah, I mean, not to tease a little bit. I mean, they literally have almost the same business model.
Yeah. So let's take a look at the freeform tool. Whenever I live stream and share my screen, my internet is so slow. Okay. So let's take a look at the past 5 years. Sure. So BJ's has grown revenue at 8%, Costco 13%. So Costco's actually grown revenue more over the past 5 years, but BJ's has grown operating cash flow more rapidly. Costco's about 8%. So revenue is growing a lot faster at BJ's. Revenue is growing faster at Costco, but BJ's is growing cash flow more. Okay. What are the I know Costco is like a super expensive stock though.
So
yeah,
one thing I'm starting to think of here, Daniel, with these two stocks and like different types of investors that might like them, like Costco has a dividend, it's bigger, it might be a bit safer. BJ's is smaller. So is there a potential that BJ's is a growth stock here? Like I would like to know is if management is planning on expanding BJ's locations and expanding their membership. Because that to me would really give a better picture, you know, like are they going to be as big as Costco one day? Because if so, you know, cheap shares, but if not,
yeah, exactly. Yeah, I would take a look at like the future growth potential. I know nothing about this business, other than you guys are saying they're very similar to Costco. So Costco is still growing super well. I would take a look at like what's BJ's growth plan. How are they going to continue growing? Like what's their runway for growth? But when you take a look at the price to operating cash flow right here, I mean, Costco is selling for 30. BJ's is half of that at 14.7. So the company is valued at half of Costco, basically.
We have a good comment here too, Daniel, from Stockado. Also, Stockado, we see you here every week. Thank you for that. Unlike Costco, BJ actually makes money from the core retail business, and it competes with Costco, but it dominates in those markets. The core retail business.
Yeah.
Interesting. Yeah. So we probably want to know more about their revenue streams then. But
yeah, just in terms of like the price of this business, I'm noticing that it's basically half on a lot of the different metrics. So in comparison to Costco, it looks a lot cheaper. Costco does look like it is growing slightly faster, but I mean, what was the revenue growth? Revenue is growing at like 12% a year over the past. Yeah, so it's got strong revenue growth. It is growing nicely. One thing to note though is that relative to this company's history, like you can see right here, its historical peak in operating cash flow, price operating cash flow was about 12. Now it's at about 14.6. So in terms of like how much investors are paying for this company's cash flows, it is at an all-time high right now.
Yeah, and so feeding into that and continuing to read these great comments from the chat. Thank you again, Stockado. It seems that, and I'm going to paraphrase these comments. BJ's was private for a while. Now they're public, and they have plans to be opening more and more stores. This is unverified, but just from Stockado, now they will open 10 stores every year. Apparently, they have 60 in New York, where Costco has 12. So this increased price operating cash flow may be because of that, and it could be going up for good reason. If they're going to double operating cash flow every 2 or 4 years from these stores, this isn't going to look that expensive in hindsight in 5 years. So this is maybe playing more into that mindset where BJ's could be viewed as a growth stock.
Yep. Yeah,
Yeah.
and that would make sense if the company is going to, invest more in growth and become more like a growth stock, then the market is kind of pricing that in. I mean, honestly, a 14 price to operating cash flow in general, I don't think is really that expensive.
Agreed.
I like, if they can continue growing very well, then yeah, I think
What's
that's,
Costco's average price to operating cash flow? I guess that's like a more mature business in a similar sector.
yeah, Costco, in my opinion, is just like very expensive, and it's getting more expensive as time passes. Like right now it's at that 30.
Okay.
So I mean, even if you take a look at the operating cash flow yield of Costco right now, it's probably about 3.4%. Yeah, 3.434%. So this isn't even free cash flow. Okay, this is operating cash flow, and it's 3.4% yield, which bonds right now are yielding 4%. So Costco's actually yielding on its operating cash flow less than a bond. Like that's how much investors are paying for this stock.
Whew. Well, it's the plot thickens.
Yeah.
No, this is an interesting one. I mean, outside of the stream, I might go look at BJ's investor relations page. I want to see what their plans are because Stockade, what you're saying is interesting. Like I know people that use BJ's, they like it, they have good service. So this might be a good one to add to the watch list. And Daniel, on that note, I guess driving us to a close here. We appreciate everyone coming every stream. Daniel and I, of course, love doing this. And we're going to be here every Saturday. Next week will be our 10th episode, making it into double digits. I know time flies when you're having fun. So every Saturday, 11:30 a.m. EST. And of course, we are the co-founders and creators of Stock Unlock. We'd love for you to head to our website, get your free trial, risk-free, no credit card. And we'd love to hear your feedback. So we'll be seeing you guys every week. And if you can't make it, you can find the recordings on our YouTube page. Any last words from you, Daniel?
Last words is I didn't even know that we were at an hour and 20 minutes. That was fun.
Dude, time is a made-up thing that humans decided to try to measure. And it never makes any sense to me.
Okay, we just got a comment really quick from Nick. Can I make a suggestion? Absolutely. Always love feedback. What is the suggestion, Nick? Now we gotta wait. So the cliffhanger, the suspense.
Yes. Thank you so much, Ralph. Thank you so much, Alex. And for all the people who aren't in the comments that we will call lurkers, we do appreciate you viewing. And if you ever want to come to the chat, say hi or send us an email, jake@stockunlock.com. I'd love to hear from you. Let's see, Nick, we're going to give you another 30 seconds on this suggestion. If you don't get it in, please email us. We'd love to hear it. I will say I'm about to start dancing at my computer right now. So I'm on like a minute timer.
Yeah.
Human things. Thanks for sharing.
Oh, wow. A lot of comments just came in. Yeah. A lot of comments just came in. Whoa.
Yeah, that might have been a glitch on YouTube's part.
Ralph says, "Where can we buy Stock Unlock shirts?" You're
going up to steal it off of my back, Ralph.
You're going up a dangerous tree right here, Ralph. We have had internal conversations about like, okay, when should we make a merch store? People want some merch, like, and Jake is always like, I want to make the merch store right now. So you're feeding into Jake.
Okay, here, ask from our audience. Everyone send us a support email asking us for a t-shirt shop, because when we go to our weekly founders meetings, I need metrics to push this. I need to show that there's people who want the swag. And then when there's enough people that ask for it, we can't help but prioritize it against engineering work. Okay, we got the suggestion from Nick. Okay, the menu, can you make it stable so when we scroll, it doesn't move? I think you're talking about the header. I think that it's, we might have to take this one to email because there's a few headers in our site, so I actually don't want to make any assumptions. So apologies, Nick. I'm not going to try to answer the question. I'm just not 100% sure what you're referring to.
Yeah,
send email us.
Email us at this email. I'm typing it out. And let us know which one it is in specific, and then we can look into it and hopefully do it for you. But yeah,
sweet. Let's end this stream. Or else, we just love talking to you guys too much. Sophie, thank you so much for being here every week. I'm gonna hit the end button now. Goodbye, everybody. See you
Bye,
next
everyone.
week.
Have a great weekend.
Smile and wave until it